Welcome to The Explainer. You ever look at a company's financials and wonder, are all their deals really on the level? Well, today we're going to pull back the curtain on a super important accounting rule, IAS 24. Think of it as the rule that stops corporate family secrets from staying secret.
And that question really gets right to the heart of it. Normally, you'd expect deals to be made at arm's length, right? That just means two totally separate parties agree on a fair price, each looking out for themselves. But what if they're not separate? Imagine a company buying all its supplies from another business, one that just so happens to be owned by the CEO's brother. Suddenly you have to wonder, are they getting the best price? And that's exactly why transparency is just absolutely non-negotiable.
All right, so here's how we're going to tackle this. First, we'll talk about why this transparency is so important in the first place. Then we'll figure out who exactly counts as a related party. After that, we'll define what a transaction is in this context. We'll go through the disclosure checklist, basically what companies have to tell you. And finally, we'll look at how to read between the lines.
Okay, let's dive right in. Why does this rule even exist? To really get it, we need to look at its main goal, its whole reason for being.
So what does all that formal language really mean? It's simple. A company's relationships with its insiders, its family, can totally change its financial picture. Maybe it's selling goods to its parent company for way cheaper than it should. Or maybe it's getting a loan from an executive with amazing terms no bank would ever offer. Now, the standard isn't saying these deals are automatically shady. Not at all. It just says, hey, you got to tell us about them. They have to be out in the open for everyone to see.
Okay, so if we're going to shine a light on these things, we first need to know who to point the flashlight at. So who exactly is a related party, according to the rules? It's a pretty big question, and the definition has to be really clear.
Now, on the surface, the official definition looks pretty simple, but don't let that fool you. It's written to be deliberately broad. It's designed to cover both actual people and other companies, basically casting this huge net so that no important relationships can slip through the cracks.
And to make this wide definition a little easier to work with, the standard basically splits it into two main buckets: people and entities. Let's take a look at what fits into each one.
So when we're talking about an individual person, it really all boils down to influence and power. If someone has control over the company or can seriously sway its decisions or is part of that key management team, boom, they're a related party. And this is a big one, so are their close family members.
And then you've got entities. The connections here can be just as tight, if not tighter. We're talking about companies in the same group, like a parent company and its subsidiary. Or it could be an associate or a joint venture. It could even be a totally separate company that just happens to be controlled by one of those key people we just talked about. The whole point is to map out that whole interconnected web of control. All right, so now we know who we're looking for. The next logical question is, what are we looking for? What kind of actions or deals between these parties actually count as a related party transaction?
Okay, listen closely to this definition, because the most important part is that last little phrase, regardless of whether a price is charged. That is huge. It means money doesn't even have to change hands. We could be talking about an interest-free loan, or letting another company use your office space for free, or guaranteeing someone else's debt. If there's a transfer of resources or services, it counts, period.
Okay, so we've established who is related and what a transaction is. That brings us to the absolute core of IAS 24, the disclosure checklist. What exactly does a company have to spell out in its financial statements for all of us to see?
It really boils down to three main areas. First, they have to talk about the parent-subsidiary relationships. Second, they have to disclose how much they're paying their top executives. And third, they need to give us the details on specific transactions with related parties.
First up, and this is pretty basic stuff, a company has to tell you who its parent company is. And if that parent company is owned by someone else, they have to tell you who the ultimate boss is, the ultimate controlling party. It's like drawing a map of the corporate family tree so everyone knows who's really calling the shots at the very top. Next, we've got key management compensation. A company has to disclose the total amount it pays its top brass. But, and this is important, they can't just give you one big number. They have to break it down into these specific categories you see here: short-term benefits, post-employment benefits, and so on. This gives you a much clearer picture of how exactly those leaders are being paid.
And third, the company has to tell you about specific transactions. And look, we're not always talking about some complex, shady deal. This can be everyday stuff: buying or selling goods, leasing an office, getting a loan. The key thing to remember is, the transaction itself isn't necessarily the problem. It's the relationship behind the transaction that requires the disclosure.
And they can't just be vague either. It's not enough to just say, oh yeah, we did a deal with a subsidiary. No way. They have to give you the details. How much was the transaction for? What were the terms and conditions? Were there any guarantees involved? Were any debts written off? This is the nitty-gritty that lets you, the reader, actually figure out what the deal really means for the company.
Okay, so we've gone through all the rules, the what and the how. But now let's get to the most important part, the so what. Why does any of this actually matter to you, whether you're an investor, an employee, or just curious?
Now this quote here is so important. It basically says a company can't just casually claim, oh yeah, all our related party deals were totally fair, just like a normal market transaction. They can only make that statement if they can actually substantiate it, if they can prove it. The burden of proof is on them, which makes it a lot harder to sweep a sweetheart deal under the rug.
And that, at the end of the day, is the whole point. IAS 24 gives you a powerful tool. It lets you dig into the footnotes of a financial report, where this stuff is usually hidden, and find the real story. You can spot potential conflicts of interest. You can see where profits might be getting shifted around. It helps you get the full picture that the big numbers on the income statement might not be telling you.
So I'll leave you with this thought. Now you know what to look for. The next time you pick up an annual report, remember that some of the most revealing secrets aren't in the headlines or the big summary charts. They're tucked away in the notes. The only question is, what might you find hidden in plain sight?